The US banking sector structurally weakened. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. Today, welcome back Drew, who's been spending some time thinking through the repercussions of the Fed's last interest rate decision last year and where that might leave us, and banks in particular, as they face the challenges of 2025. How are you going today, Drew?
Good, Chris. Thanks for having me back on.
Thank you for coming back on. Now, interesting to think this through because this obviously happened sort of towards the end of last year, but it was a little while ago that the Fed went back to thinking about cutting interest rates, and they did that, and then really there was a bit of reaction in the bond market. Can you talk us through what sort of happened then, because it leads into the discussion today, and particularly how the bond markets reacted to that?
Yeah, absolutely. So the Fed started cutting interest rates late last year, starting in September, and they were celebrating that inflation's been defeated. So here we go. We can go back to slightly looser monetary policy. And what's really interesting is the dynamics that followed, and digging into it a little bit, you can sort of see that even though they started cutting interest rates, celebrating that inflation's been defeated, they expected the bond market to react with surging bond yields as the bond market priced in a resurgence of inflation. They really saw this coming because once they cut interest rates, what we saw is a couple of months of bond yields just shooting up. And the bond market was basically pricing in inflation coming back, saying, look, we don't agree with you. Inflation's not defeated. You're cutting things way too early. And people will quite often say, oh, the Fed's really bad at timing things, or they're really bad at their job. They don't know what they're doing. But I really take the view that they're really good at their jobs and they know exactly what they're doing. It's just that what they say and what they do are oftentimes two very different things. And they've each got their own purpose for it. Now, while they started saying that inflation has been defeated, a month before they started cutting the interest rates, they reduced the adequate reserve requirements for private banks.
Hmm.
So what that means is that if bond yields started shooting up, and as a result of that, bond collateral values started going down, that's just how the bond market works, that the private banking sector would be able to withstand this. Because banks hold mainly government bonds as their collateral, when bond yields shoot up, the bond collateral values drop, and the balance sheet of private banks starts to look a lot more unhealthy. If the central bank had not reduced the adequate reserve requirements before cutting interest rates, the private banking sector would have had alarm bells ringing just a few months afterwards saying, hey, we've all fallen, below the adequate reserve requirements, and it would have been a huge issue. But they quietly reduced these reserve requirements. Then they started cutting interest rates. Then the bond yield started shooting up and collateral values started falling. And no one's really said anything about the private banking sector because they're above the new levels. So some people see this as the bond market disagreeing with the Fed. But really what I think has happened is the Fed cut interest rates, knowing what the bond market would do, knowing that it was too early and that inflation would come back. And now 3 months later, what they're saying is, oh, we're concerned about inflation, so we're going to put a pause on rate cuts. But they already were concerned about inflation in August before they even started cutting interest rates. So that's essentially what's happened over the last few months of 2024. And right now we're seeing at a point where bond yields have gone up for a consecutive few months. And with the Fed's recent, speeches or jawboning, saying that they are now pausing interest rates, the bond market has cooled off, the bond yields have cooled off a little bit, and that's given a little bit of breathing room to the private banking sector.
I think my problem with a lot of that, like what's been going on there, is, like you said, I do think they know what they're doing, and I think there's a lot of 4D chess being played, that they're trying to sort of have their cake and eat it too. They're trying to get all of this to work, which is obviously their job, to get to create, to manifest that soft landing scenario where everyone wins and everything's happy. But ultimately, I think that's where the criticism comes from for the Fed, that they do play that game very well, but when they get it wrong, the consequences are huge for everyone. And I think that's the risk potentially here. And I'm interested in your perspective on it. You made the point that the US banking sector we haven't really been thinking about them, but we were very much thinking about them in 2023 when that was front and center, the issue. do you think that ultimately the structural integrity has been undermined here? That if they get a move wrong in this game of 4D chess, that ultimately we're right back looking at banks again and potentially them undermining the whole economy because they just make that wrong step.
Yeah, absolutely. I think the point that you made was very interesting about if they get it wrong, that everybody loses, but there are always winners in those situations as well. And I think the question is, who are they really serving? You know, the Fed's official mandates are to, the official mandates are to uh, keep an eye on unemployment and inflation, essentially. But they manage their mandates using manipulation of the money supply. So really, they create inflation, then they temper it, then they create inflation, and then temper it. So if you look at what they did late last year as well, unemployment numbers were low, employment was really strong, and they got interest rates anyway. So once you dig a little deeper, even their mistakes, I think, end up being beneficial to a few people that they are probably serving. Now, if we dig back into what happened late last year, there's a few aspects to it. Um, it did result in the banking sector being structurally weakened. No one can argue about that. You know, the reserve requirements have been reduced, so it's a less robust banking system in the US now, objectively speaking. But what else? What else happened in that time? Well, if you look at, they knew inflation was going to come back, but they did it anyway. Do they want inflation to come back, and who does that benefit? Well, if the government has surging government debt that's denominated in dollars over a long period of time, inflation actually benefits the government because it reduces the value of their debt. It allows them to continue spending and continue borrowing without going bankrupt because the value of the debt just keeps going down. Now, yeah, they keep increasing the debt ceiling as well, and there's a few other aspects to that, but inflation over the long term, is that beneficial to the people that are deciding the positions of power within the central bank? The other aspect of it is, well, private banks have been structurally weakened. Whose benefit could that be in? I won't dig too much into that, but with central bank digital currencies coming down the path, I don't see why they wouldn't clear the way a little bit ahead of time. But what's less speculative and really clear that we can objectively say about what happened in the last 6 months with this decision is, yeah, private banks have been weakened, inflation has been sort of messed with a little bit, but really what's happened is the bond market is healthy again because since the end of 2022, all through 2023, the cash rate was higher than the yield on government debt, on bonds. So why would anyone buy a long-term government bond and take duration risk for a lower return than just getting the cash rate in the bank? So government debt has been very unappealing for about a year and a half. And what's happened with bond yields shooting up while they cut interest rates is now we have yields above the cash rate. So what they've done is they've made government debt more appealing and they have resumed normality to the bond market. So while it created a issue in the private banking sector, while it messed with inflation a little bit, while it messed with financial markets a little bit with bond yields shooting up, really they've said, okay, cool, you guys can continue issuing debt and the debt that you issue will be bought up because it's now appealing once again.
And I would argue that's going to become essential later this year because there's a lot of debt that needs to be issued. We know that under the previous administration, there had been a lot of, I keep referring to it as cheating, where they were issuing really, really short term debt and sort of kicking the can down the road, not issuing that longer term debt because the rates were too high. But that what you've just described is the perfect setup that they maybe do know a little bit about what they're doing to set that up to have someone wanting to purchase that debt because otherwise they're going to have a real problem later this year.
Exactly right. If they have a bond auction and then nobody's buying it, that's a huge, huge issue. And so they really have played that 4D chess, I think, quite beautifully. And you dig a little bit underneath the surface, and I think they're really amazing at what they do. So good on them. It's not that it necessarily serves the people, but they have a job and they're doing it well.
How then do we balance this against what we've been seeing happening with investor behavior, particularly when we think about gold? Because I would argue that potentially central banks have been taking the other side of this just in case the insurance bet, if you will, individuals as well. Is that what's at play here? Is gold really seeing that resurgence because there is a concern that they don't get it right over the long term, that there is something coming on the horizon?
Absolutely. I mean, the reason, as we all know, the reason central banks hold a large amount of gold is for that hedge against financial instability and financial collapse. If the banking sector has been structurally weakened, private investors as well will want to hold their wealth in something that does not have that counterparty risk of holding it in a private bank. And when you see things like bond yields moving all up and down all over the place, and you see financial markets being affected by this as well, if there is some sort of structural break or a tantrum in the bond market, it's going to affect stocks. It's going to affect not just private banks, but various places where people hold their wealth that have counterparty risk within the financial system because it's also intertwined. One thing does have a domino effect all the way across. So more and more investors are desperately seeking an asset that does not have counterparty risk, that does not have any sort of centralization, and really provides a hedge against the debt-based system. And that's where gold has been. I mean, there's a reason it's one of the best performing assets over the last couple of years. It's certainly the best performing commodity. And while commodities across the board, might see a bit of a resurgence over the next 5 to 10 to 20 years because of, inflation and various reasons, the the front and center, it's gold is definitely taking front and center in that landscape.
Look, a fascinating discussion, and one that will continue to unfold, I suppose, because we will be very interesting to see. We had very strong employment data, like the last data that came out of the US. So it's creating an interesting backdrop when you talk about that dual mandate of the Fed of what they're actually going to do. So we'll continue to watch that and pay attention. But so far, so good in how they're playing it. Well, let's just hope they continue playing it that way. Otherwise, let's hope you've got some insurance gold in the background by the sounds of things. But thank you for your work on that today, Drew.
Yeah, absolutely. Thanks so much, Chris. Talk to you soon.
Thanks everyone for watching. We'll chat again soon.